In this presentation, we will be discussing control activities and tests of controls related to the purchasing process. So remember, within the audit process, we're thinking of the purchasing process now, the purchasing cycle in essence. We've discussed what inherent risk, what control risk is. Now we're going to be thinking about the control activities, the controls being set up in order to deal with the risk factors by the company, by the management, those checks and balance type of systems that are going to be put in place. We, of course, as the auditor, thinking about those controls that are in place as a factor that will then be used in our audit plan, considering the control risk and the inherent risk to help us decide the detection risk to decide how much substantive testing we want to do. So control activities and tests. So the tests of controls, of course, the tests of controls on us as the auditor for testing of the control activities that will be set up by the client, the management for the business in the purchasing process. So first we have occurrence. So that's the assertion of occurrence. So occurrence has purchase, cash disbursement transactions, and events that have been recorded or disclosed have actually occurred. So remember that what that means, of course, occurrence, we're usually thinking about the end product. We see the end financial statements, the accounts payable in essence, and other kind of related accounts that we're testing with relation to the purchasing process. And then we're going to go back and say, hey, has this transaction actually occurred? And such transactions and events relate to the entity. And of course, have they occurred, and they are transactions related to the entity, as would be indicated by what is on the financial statement. Completeness, on the other hand, purchase and cash disbursement transactions and events that should have been recorded have been recorded. So now we're thinking about, is there anything that has occurred that isn't on the financial statement? Are the financial statements, in other words, complete? Has all the data been included? Here, we might be a little actually more concerned with completeness to some degree, because if there were purchases possibly that aren't recorded, that might mean that the liabilities, because if we're considering accounts payable a liability, we might be more concerned that it would be understated as opposed to overstated, and that would be having to do with not recording some type of liability on it. Related disclosures that should have been included in the financial statements have been included. And then we have authorization. That's going to be the assertion. Purchase and cash disbursement transactions and events have been authorized properly. So do we have the proper authorization? Then we have the accuracy assertion. So the assertion of accuracy with regards to the purchasing process. Amounts and other data related to recorded purchase and cash disbursement transactions and events have been recorded correctly. Related disclosures have been appropriately measured and described. Then we have the cutoff assertion. You'll recall that's the end of the year cutoff date, the proper time period accrual accounting, considering the matching principle or expense recognition principle with regard to the purchasing process. And that's going to be purchase and cash disbursement transactions and events have been recorded in the proper accounting period. And then we have the assertion of classification. Classification, purchase and cash disbursement transactions and events have been recorded in the correct accounts. Then we have presentation. Purchase and cash disbursement transactions and events are correctly aggregated and disaggregated and clearly described. Related disclosures are relevant and understandable. So those are going to be the assertions within the purchasing process. Now we're going to be considering the tests of controls with relation to those assertions. So those are the assertions being made. We want to be able to test those controls. So now we have occurrence. How would we test for occurrence? We have observe proper segregation of duties. Recall that the separation or segregation of duties is going to be a major internal control. We want to be able to observe that those segregation of duties are in place. Test a sample of vouchers for the existence of an authorized purchase order and receiving report. So we can go through and we can test a sample of the vouchers and see if there is authorized purchase order and receiving report related to it. And clearly, if we then have a receiving report and a purchase order, and we've actually received it, we got the receiving report representing that we have received it, then we would think that it actually occurred. And remember, what we're looking for on occurrence is that it's on the end, and the end result is there. It's on the books, meaning it might be there in terms of inventory. And if we're concerned with basically the inventory, if it's actually been received, that being an asset, so we're going to be concerned with the asset that could be overstated, then we can take it back to the receiving report If it's been received, of course, then on the receiving report, then we would have more confidence that it has indeed occurred. If data is accessible, use audit data analytics to match the populations of vouchers to related purchase orders and receiving reports. Then we have completeness. So completeness, the testing of the assertion of completeness. Review procedures related to numerical sequence of purchase orders, receiving reports, and vouchers. So when we're thinking about completeness, we're thinking, hey, has a transaction happened that wasn't recorded in the system? The pre-numbered documentations help us to do that, because if they're pre-numbered, then if we could have a missing number within the pre-numbered sequence would be an indication that there had been something that had been done that hadn't been recorded. So that pre-numbering is actually a very important, basically, internal control, similar to the pre-numbering we would have basically on our checks. If we see a missing check number, then we have we're going to question that. We're going to say, hey, something's wrong. The pre-numbered systems and these other types of forms similar to that. Traced a sample of receiving reports to their invoice and vouchers. So notice now we're going basically the other way. We're tracing back the other way. We're going to go back. We're going to go to the receiving report. That's going to be, so we're imagining we're in the warehouse. We're going in the, we're getting the receiving report that represents that we've received the goods. And now we're going to trace them back to the invoice and the voucher, because now we're testing for completion, as opposed to us going from the end result, basically the balance sheet or the general ledger, and then going to the source document, which would be the receiving report, which would be the indication that the actual transaction happened, that we would do for occurrence. So notice that again, these two tests are tests that most people, if you were to ask them, yeah, you'd say that's an appropriate test. But a lot of people will get confused as to whether you apply the test to completeness or occurrence, which is a common test question. It's something we have to kind of keep straight when we think through the appropriate audit plan. And then we have to trace a sample of vouchers to the purchase journal, and we want to review the financial statement disclosure checklist. Then we have authorization, so that's the assertion, the tests related to it, examine purchase requisitions or purchase orders for correct approval, review client's competitive bidding procedure. So we're going to examine the purchase requisitions to see if we have that authorization and that approval process. Then we have the accuracy. How can we test for the assertion of accuracy? We can recompute the mathematical component of the vendor invoice. So we can go to the invoice. We can recompute for mathematical accuracy. We can agree information in the sample of vouchers for product, quantity, and price. So we can go into them and agree that information out with whatever sources that we can for the product, quantity, and price. And we can examine reconciliation of vouchers to daily accounts payable report. So we'll take a look at the actual vouchers and go to the daily accounts payable report, because we should be, of course, recording this stuff on a daily basis. Then we have the cutoff information. That's the end of the year cutoff assertion information. Basically, do we have this information recorded in the proper period? And so we have agree the dates on the receiving report with the dates on their vouchers. And we have the agree the dates on the vouchers with the dates they were recorded in the purchase journal. So let's take a look at that again. If we say we want to agree the dates on the receiving reports. Now the receiving reports, remember, are probably the reports that we're going to be using to verify when the inventory should actually be recorded. Because when we received it, we actually have the inventory at that point in time. Typically that happens at the same time that we get the bill. So under the expense recognition principle or the matching principle, you would think that the receiving report for many type of organizations would be that point in time that the work had been done. We had actually incurred the expense. We could then record the inventory and record the related payable at that point in time. So we want to agree the date. We have the receiving report, which is the date we would want it on the books according to the matching accrual principle, with the dates on the vouchers. Now the voucher, might be something that the system uses to record that information. So when we put the information into the accounting system, it might be driven basically by the vouchers. So they should be, we want to compare those two dates and see if we have a timing issue as to when the information was recorded into the system and when the information was actually received, and it should be on the books when it was basically received under most circumstances. Agreed dates on the voucher with the dates they were recorded in the purchase journal. Now again, the voucher, the voucher would probably drive what's going to be recorded in the purchase journal. The purchase journal is what's actually going to be recorded in the accounting system. So again, we want to agree those dates out, We want to see if there's any lag, any difference within those dates, and we want to basically see that when should it be recorded. And notice we're usually considering it by the cutoff. If it's a 12/31 year end, sometimes it's at the end of the year. We're trying to see, well, this is the time period that it should be on the books. When was it actually recorded into the system? And trying to determine if there's any kind of timing difference that would have happened with the cutoff testing. And then we have the classification, review purchase journals and general ledger to assess if reasonable. Examine a sample of vouchers for correct classification. So we're going to get the purchase journal and recall that the purchase journal is going to give us basically a list of those purchasing transactions. It might be a report within the accounting system that may not be called, in essence, the purchase journal, depending on the accounting system we're going to use. We're going to examine those purchases and make sure that the classification is correct, meaning, did we put the purchases into the right account? And obviously the accounts payable would possibly be part of the purchases, and then the other side would be something like possibly inventory or possibly some other type of supplies or something like that within the proper classification. Then presentation, how can we test for that assertion? Review purchase journals and general ledger for correct aggregation and disaggregation of purchase transactions. Determine if disclosure is needed. Now we're going to take a look at the control activities and test cash disbursement transactions. So we're considering cash disbursement transactions. We're looking here at occurrence, so cash disbursement transactions within the purchasing process considering occurrence. The auditor will test for misstatement caused by a cash disbursement being recorded in the entity's record when no payment was made. So we're thinking here about occurrence, something that happened, cash disbursement that was recorded when no payment was made. The main control activity to prevent this misstatement include proper segregation of duties. So in order to prevent this, we would want the segregation of duties. Independent reconciliation. So we want an independent type of reconciliation process. So we'd have two individuals involved, people entering the data, and then the reconciliation being done by someone else, so that if there is a problem or something wasn't recorded properly, it would be picked up by another individual as opposed to something that could be altered within the reconciliation process. Review of vendor statements and monthly bank reconciliations. So we should be doing, of course, the bank reconciliations. Anytime we deal with cash, the bank reconciliation process is going to be a key component involved. Cash disbursement transactions. Now we're going to think of the completeness assertion. Completeness assertion. Primary audit concern is that the cash disbursement is made but not recorded in the records. Of course, that's our primary concern, that the cash went out and it's not been recorded in the records. So how could we guard for that? In addition to the control tests for occurrence, so we're going to apply the same test, in other words, as we saw for the assertion of occurrence, the auditor should also account for numerical sequence of checks and reconcile the daily cash disbursements with postings to the accounts payable subsidiary records. Now we'll go through assertion, again related to cash disbursement transactions. Good segregation of duties decreases the likelihood that unauthorized cash disbursements are made. Again, major control that we would have in place, we should have in place, that we hope as auditors that management has in place, is good separation or segregation of duties. The person who approves a purchase should not have direct access to the cash disbursement. So the approval process should be separate from the cash disbursement process. Now we're considering accuracy with regards to cash disbursement transactions. One of the primary audit concerns is that the payment amount is recorded incorrectly. So we want to make sure that the payment amounts are recorded correctly with regards to accuracy. To detect this error, entity personnel should reconcile the total of the checks and if we have the electronic fund transfers, the EFTs, issued each day with daily cash disbursements reports. So we want to have a daily cash disbursement reports, and we want to be able to check those off with the checks and electronic funds transfers. Obviously, we want to think about the bank reconciliation process with regards to accuracy as well. Then we have the assertion of cutoff relating to cash disbursement transactions. We have tests of controls will include reviewing the reconciliation of cash disbursements with postings to the cash disbursement journal and accounts payable subsidiary ledger. Auditor will also test cash disbursements before and after year end to make sure the transactions are recorded in the proper period. So really with the cutoff, remember, of course, we're considering those year-end types of transactions. So oftentimes we'll be testing transactions that happen with relation to cash close to the end of the year. We'll be doing some audit testing basically on those transactions that are happening fairly close to the end of the year and just after the year. And recall when we do cutoff testing that although we're testing for the year end, let's say 12/31, December 31st, clearly we're doing the audit sometime after that. It's probably not going to take at least February and possibly March before we get the audit done, possibly. And that means that we have, at least another month or at least a half a month, even if we're really fast, that we can go in and test the cash transactions after the year end is over. So that's part of the testing that we'll typically do for cutoff testing. Cash disbursement transaction classification. Auditors worried that cash disbursements may be charged to the wrong general ledger account. So it's possible we have the wrong general ledger account charged to. The use of a chart of accounts and independent approval and review of the account code on the voucher should provide sufficient control for this. So that's going to be classification. Now we're thinking about purchase return transactions. So internal controls, now we're considering their transactions of purchase return transactions. Generally, the number and amount of purchase returns is not material. So notice we're thinking about returns process here, not people returning inventory to us that we sold, but the returns that we have to our vendors. Normally, hopefully the companies we're working with have good vendors. We have good relationships with them, and we're not having a lot of returns to the vendor. We're not purchasing stuff, whether it be inventory or something else, and then saying this isn't what we want and returning it. So normally, that's not going to be a substantial part of the process. It won't be material and therefore won't be a large concern for the audit process. Often the auditor does not test controls related to purchase returns for this reason. However, substantive analytical procedures are used to test reasonableness of the amount. So we might not do the test of controls because we're going to say, hey, it's not a material component. There's not a lot of purchase returns possibly. However, on the substantive side of things, since we're not doing the test of controls, we will do some substantive testing, and that substantive testing will at least be with regard to the reasonableness of it. We'll use some ratio analysis and consider the reasonableness of the purchase return transactions. Now, the assessed level of control risk and how that applies to or relates with the substantive procedures. If the results of the test of control support the planned level of control risk, then auditor will conduct substantive procedures at the planned level. So in other words, if we test the test of controls, we've got our audit plan set up, and the test of controls meet what our expectations were, we'll move forward. We'll do the expected substantive procedures that we had planned to do. If the results did not support the planned level of control risk, then we're going to have to, auditor reduces the detection risk. So what's going to happen then, because we've already set up the plan, we're at this point in time, we've said we're going to test controls. If they meet our planned level of control risk, then we're going to move forward with the substantive testing which we have planned. However, if the test of controls do not meet, we test the controls, they don't meet the level that we wanted, then the audit's going to reduce the detection risk. Now, again, we want to consider this relationship. Remember that when we think about this relationship, it's easy to think that, well, if we rely on controls, or it gets easier, we start to comprehend at least, that if we rely on controls, then we're going to do less substantive testing. If we don't rely on controls, we do more. However, it can be a little confusing to think of the direction of these ratios. So remember, if we're talking about internal controls risk, we're thinking about the risk that the internal controls will not detect an error. So if we can set the internal control risk low, we think the internal controls are strong, and therefore we'll do less substantive testing. In this case, if we think the internal controls are weak, we set the internal control risk high because we don't think it's sufficient to catch the error. It's more risky, so we set the internal control risk high. And then the detection risk, which represents the risk that the the substantive testing mainly, will not catch an error. That detection risk, which we're going to set and determine how much substantive testing we're going to want to do, if we can rely on controls, we're going to set the detection risk actually high, meaning we're going to do less testing. So it's going to be more possible for something to not be caught in the substantive testing because we're relying on the controls. However, in the case where the control risks are not something that we can rely on, then we're going to set the detection risk low, and the result of us setting the detection risk low is that we have to do more substantive testing. So in this case, if we can't rely on controls, we're going to set the detection risk low, and we're going to increase the level, therefore, of substantive testing with relation to meet that lower threshold of detection risk.